Welcome to the Ideal Investor Show. Join us on the journey to financial success. Let's go. Hey everybody, I'm coming to you today with a little bit of a smile on my face because I just read something and I immediately said, I need to make a little recording for our podcast audience about it because I thought it was such a fitting thing. I'm not exactly sure if it's really true that Warren Buffett said it. It's a little bit out of character, but then on the other hand, it isn't. He is a very wise man and he's been for a long time and has been making those kind of statements that then ended up in lists of quotes and so forth for a very long time. So here is something that we can first have a little laugh about and chuckle about and then maybe think about what's behind it. And the quote is, calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. Let that sink in for a moment. What this really gets to is when you are trading in a market, whether it's a crypto market or a currency market called the Forex, or you're trading in any of the different exchanges in the stock market, you should be called a trader. And the reason is because you are, in most cases, not really that much interested in those companies, that the stocks that you are trading. What you're really interested in is what's called volatility. You want to basically be able to predict which company's share price is going to go up in the next few days by a lucrative enough amount that you can either buy it or sell it. Right? Because you always have the option to say, I buy something because I think the price will go up, or I short something, meaning I pre-sell it, or what's called empty sell, where you predict that the price will go down. And then you make a profit on the amount that it goes down, or the other way around, you make a profit by the amount that it went up. The underlying asset is only of secondary or even less importance. What's really important is, does it move a lot? That's, by the way, also a reason why anything that is in the very early stages of their maturity curve, or of their life, so to speak, are typically much more helpful for traders, whereas long-term investors benefit from patience. And that's why they're called investors and not traders. And anybody who is constantly buying and selling on the stock market, even on a daily basis, should be called a trader and not an investor. Because they're really not investing into the company. They're not investing time to research the company in detail. They're not investing in thinking about if the goals and the vision of the company have a probability of becoming reality in the long term. What they're doing is they look at the number of what it's worth today. They look at some parameters in a spreadsheet and they make a prediction, it's going to go up or it's going to go down. Based on that prediction, they either buy or they sell. The importance for us in this context is, if we look at our real estate investments, but also when we're looking at the other diversification components in our portfolio. And just to mention them again, I recommend that we have about 65% in our portfolio in real estate. We have 10% in gold or silver coins. We have 10% in cash. Then we have 5% in crypto and 10% in stock. So when you look at any one of those and you were to try to trade, in a sense, even with real estate, when you say, okay, I held this real estate for 2 years and it went up 30%, so now I'm basically selling it. That's kind of like trading in the stock market on a daily basis. But you're not an investor then. Then you are just trading. And what we are trying to teach is how to be an investor. Why are long-term investors ultimately the winners over the traders? For people who trade, they trade in the majority along the overall trend of the economy. And so as long as the economy is doing reasonably well, they can actually trade with reasonably high assurance that they will win if they really pay close attention on a daily basis and make this basically their full-time job. If, on the other hand, the economy is getting into a downturn, then obviously all the companies that you can trade on the stock market are affected by a declining economy. And yes, you can still make money with short selling, but what really happens is that the best companies are going to sustain the downturns the best. And when the economy turns around, they're going to go up the most, right? And that is something that you can benefit from. I give a quick example from the stock market. There was a time when Amazon was a very young company, and it went from $10 to $50 to $100 to about $150. And then this dot-com bubble burst around 2001, 2002. Now, Amazon was still a growing business. They gotten bigger and bigger, more international, doing great. But the economy had this hit. And the stock that was $150 a stock went down to $9. Now, the question is, what would a trader do? A trader would basically sell everything, hopefully before it went down, and do nothing anymore. If they didn't sell, they were basically frozen in place. And it took years for Amazon to come back. What would an investor do? An investor would have started buying Amazon because they believed in the company long term when it started out with $10 and then $20 and then $50 a share. And maybe they would be buying a little less when it's $100, $120 and $150 a share. But guess what? In that year where the market collapsed and the shares went down to $9 and then came slowly back to 12 and 15 and 20, they were not disgruntled. They just kept loading up. That's where, when you listen to people that have been in the market and have been around for a long time, you hear these statements about, I wish I would have bought IBM when it was young, bought Microsoft when it was young, bought Apple when it was young, bought Amazon when it was young. The point is not to say how much volatility, how much ups and downs did they have. The point is always, when you buy something that you really believe in, and then hold it and keep adding to it for 10 years, for 20 years, for 30 years, similar to our real estate investment, especially when you pick the really great companies that I mentioned earlier that have that longevity, that have that great vision. Then you make out like crazy. So you could compare to the traders trying to make a certain amount of money every month, where the investors go for the big time, for the big money, for the big benefit over the long term. And that's really the difference. And you have to ask yourself, who do you want to be? One of the big realizations that I've had in the last 2 years is that most people don't have enough patience. And I catch myself even every once in a while as well, where I'm tempted to say, well, this has developed so well, I think I should sell. And then I remember these lessons about what is a long-term investor versus a trader. And then I keep it and keep adding to it when there is an opportunity. So I want you to ask yourself, are you a trader or are you a long-term investor? And if you say, I want to be a long-term investor, then hold on to the things that you have. Evaluate them for, are they really good companies or good investments for the long term? And then just be patient. So that's it for today. Be well and stay safe, and I'll talk to you tomorrow.